what we are doing today is conducting our daily webinar presentation. I want to thank you for taking the time to join our daily webinar. Enjoy the education and ask questions along the way. The webinars just provide phenomenal daily content and education for our members. We're going to show you how to look at the financial system and interpret what is going on there, because they absolutely control, manipulate, and drive price actions in the market. Okay, ask any questions along the way. We're going to cover a ton of information. Just raise your hand or type into the chat box, or unmute your microphone if it's just a really pressing question that you have. We'd love to address it with you. Okay, we appreciate your time and attention to show you how boring successful trading can be when you actually have the right strategy. Okay, many of our members make more than the cost of their membership during their trial, and our trading plan takes less than 2 minutes to execute at noon Eastern daily. Okay, it takes me less than 30 seconds, but I've been doing this for quite a while, and I typically do it from my cell phone like I just did, and you can do it from anywhere in the world with a cell phone. So I'm going to put my number up here, guys. Feel free to call me or text me to set up your free coaching session with me. Okay, call me at 505-322-7515 with any questions you have about the system, or simply ask them in real time during the webinar presentation. Okay, make sure to save my number and feel free to call me with any questions along the way. Okay, and it's 505-322-7515. Guys, our entire philosophy is based on Warren Buffett's 2 rules. Okay? Rule number 1, never lose money. Rule number 2, don't forget rule number 1. Okay. The really coolest part about this, guys, is literally within a single week, you can quickly establish a hyper defensive portfolio. Plus, you'll completely eliminate business risk by owning a stake in 1,500 plus companies with just 4 ETFs. Okay. Trade alerts will be sent out via text message and email Monday through Friday. We engineer our positioning in coordination with the financial system and macro environment. Jason will go into depth about those 2 things here in a moment. Okay, so you are in the daily video webinar presentation. Okay, Jason typically hops in about 12:05 Eastern to really dive into detail about what we're doing and why. Okay, you can access the live presentation from your trade alert email we send out each day. Simply click on the image that looks like a play button. Okay, and then conversely, if you're catching this recorded too, you can always just click on that. After we've started the presentation, it's going to take you to our YouTube channel and show you the recorded version. Okay, please ask any questions live during the presentation. Just click on the icon to unmute your microphone, or simply type into the chat box. All right, and if you're viewing this delayed, no fun for you. We would love to interact with you live in our live presentations and show you the actual trade alert. Okay, you can always review our track record. We build trust with our clients by being 100% transparent with every position we've ever had. You can always access our track record at portfoliobuilder.io/track-record. Okay, please, I encourage you guys to go there, look through every single position we've ever put on. Okay, a couple things that you're going to need to have in place to get the most value out of your trial: a brokerage account set up to follow what we're doing. You're going to have options enabled as well. Ability to take 1 to 2 minutes to follow our trade. Okay, your time frame is going to be from noon Eastern to 4 Eastern each day to enter that trade. Number 3, you're going to need a mobile phone to receive text message trade alerts. If you use a landline when you sign up for your trial, just email Ryan at portfoliobuilder.io and he will add you to the distribution list. You're going to need email provider that's in good working order as well. Okay, current allocation for our portfolio: beautiful balance of risk on and risk off assets. 50% is going to go into equities. That's going to be the SPY and the EM. You'll own 1,500 of the best publicly traded companies on the planet by owning that. 40% of that allocation is going to go into the TLT, or the 20-year treasury note. Okay, that's on the risk off side. We also have 10% risk off in gold. Okay, and currently we have GDX instead of spot gold, and Jason always touches on that as to why. And then for some reason, guys, if you did not get today's trade alert, okay, email Ryan at Portfolio Builder, or simply hover your mouse here, okay, and hit the chat button. You can interact with Ryan directly. It's really cool. We have a phenomenal level of live support that's just not offered in our industry. I just absolutely love to offer that level of white glove customer service and encourage you to interact with us communicate with us every single day in the live presentation. So with that, Jason, I'll hand it over to you, bud.
Excellent introduction. Thank you so much, Dean.
My pleasure, bud.
Dean likes to put me to work. Let's see what we can do for you guys today. Okay, welcome Portfolio Builder members. Today we'll start off by reviewing the trade alert, and then we'll go into a deep dive into the analysis, what's driving our predictions. So we had a nice profit on the SPY today. Just to do the accounting on the return, or the audit, as I like to phrase it. We put out this trade on the 15th, and today we closed it out. The trade started off with purchasing a lot of 100 shares of the SPY and then applying options on top of it. So we typically like to sell call options and purchase put options. The SPY traveled from 328.80 to 331.23 for an increase of $2.43 per share. The option caller, which is a popular phrase for that combination of options, was a debit of 19 cents initially, and to close it out today, 12 cents. So we had to give back 31 cents out of 243 on today's trade alert. I like to nickname this style of trade a loose option caller. It's a bullish trade, but if we're wrong, we have downside protection, which also gives us another nickname called atomic bomb proof. That's how strong our trading strategy is, because we always have downside protection with a long put. Most investors just don't have that downside protection. If they do, it's usually very rarely applied. Our portfolio always has downside protection on all 4 ETFs we trade. So this means we have to get the market direction very accurate to derive profits, because we're always paying off our put options before we get to recognize a profit. So another big win on the SPY. We've had a lot of wins on the SPY, and my outlook remains bullish for the S&P 500. To look at today's trade, let's scroll down. And again, in every trade alert, you'll get a visual on how to enter and exit the position. So you did have to buy to close your 332 call and allow for your put to expire worthless today. Step 2, we are going with a little tighter option caller because this does need to work until Wednesday. We're taking the market's off Monday. Tuesday we'll close out our emerging markets trade, and then Wednesday we'll be back to the SPY. Today's trade was to sell to open the January 22nd 333 call, and to buy to open the 330 put. So we collected a credit of 38 cents and paid a debit of 60 cents. So if there's any kind of volatility, profit taking, surprises from the impeachment, who knows? We're protected and get a guaranteed $330 per share on our SPY, no matter how low the SPY could possibly go between now and Wednesday. So it allows investors to sleep like a baby and really not worry about what may happen. Now the catch is it does act as a drag on our returns. So once again, we have to be very accurate with market predictions to generate the gains we have accomplished so far in the first 13 months. We're up to 23 people live. Thank you guys so much for joining us. Let's take a look at our risk graph. Every trade alert is also accompanied by a risk graph. Now I do believe by the time the trade alert made it out, I think the SPY was up an extra 20 cents. So how does that play out? Well, first of all, I wouldn't change today's trade alert even if you're paying a little bit less for your put and collecting a little bit more from your short call, which would be the case. Simply put, you're going to make a little more on today's trade alert than I'm broadcasting in this presentation, but you'll make a little less on the trade if it does turn out to be a winner into next week. So we found that because we issue the trade alerts very close to noon each day, our members are able to get very close to the same results. And I do see a chat. Ron says, nice calls on the SPY and the TLT. Oh, thank you, Ron. So we'll go over that TLT position. There's some good news that came out last night that was pure luck for us on the TLT that did hit a big win on the TLT for us. Okay, so that's the trade alert. Why do we pick these strikes? Well, and why are we bullish on the stock market after it has gone up nonstop since September? What the heck's going on? So, okay, first of all, this is one of the key things I like to look at, which is where are the owners of the SPY willing to write call options? This is where they will be forced to sell their shares of the SPY to call option buyers and can often act as resistance in the short term. So you can note that we did sell the 333 call, anticipating that the SPY is going to have quite a hurdle getting over this massive position that's loaded up at the 332 strike currently. And also there are already a number of underwater call options at 330. So that is a little bit alarming because when the call options are exercised, that's going to force a lot of SPY holders to sell their shares for a loss relative to the call option. Of course, if they've been holding the SPY, we all know that we're all up big. Okay, so that's one key indicator. The next key indicator I like to track is something that is released every 4:30 by the Federal Reserve, and it's called the H41 release. Now, if you like to look at the visual of the Fed's balance sheet, that does get updated a little bit slower, but this is where they do announce every Thursday after the market's closed changes to the Fed's balance sheet. And so the analogy I like to give investors is if there are 3 stocks in the middle of our little circle here, and combined, all of us, let's just say all 21 of us live on this webinar, let's say we have an accumulative total capital of $100 that can be invested in these 3 stocks. Well, what are those 3 stocks probably worth? Well, maybe 33 bucks on average. What happens if all of a sudden our money supply doubles? What's the relative value of those same 3 stocks? Well, it doesn't take a genius to figure out, well, probably it's $66 per stock. So that's the basic idea that investors are using when they look at this data from the Fed, where they discuss their balance sheet. And so right here, we have the detailed accounting of what's happened week over week in their balance sheet. And my expectation, due to the sheer amount of treasuries being auctioned this week, which we can track right here, is that the Fed's balance sheet would indeed grow, as this is the portion of the U.S. debt that the Fed's currently willing to purchase and permanently put on their balance sheet. Okay, so we had something like $140 billion issued this week alone, some of which is being auctioned on the 21st. But regardless, the expectation was that they would resume the growth of their balance sheet. Now, keep in mind, last Friday, we had a shock where they reduced the balance sheet by $25 billion. So let's just look at this and I'll teach you guys how to read it. To make your life simple, now my job really is to read the details of this. And one of the key things I'm really interested in is when they stop selling the notes and the bonds and start purchasing them, because that's going to be the moment where we're going to change our perspective on how we trade the TLT now that we're in a phase of de-escalation with China. But what you can note is they are aggressively picking up the treasury bills, and it's no coincidence that they picked up $173 billion of T-bills, and to my recollection, they issued just around 170 billion. So they are buying up all the short-term debt and putting in the balance sheet. Let's look at the growth of the balance sheet to make your life easier. Scroll down, pay attention to this data point right here and this data point right here. Now, calculating in trillions can be a little confusing. To simplify it, I like to just look at these 4 digits. So the current balance sheet is $4,224 billion, or 4.224 trillion in their balance sheet. And previous was $1,197 billion, or 4.197 trillion. So they grew their balance sheet by $27 billion, which is fuel for the S&P 500. Why are they doing this? It's because there's not enough demand for the US debt. And so the government needs yields to rise to attract foreign investment so that we don't continue to weaken the dollar by hitting the printing press to fuel the US government. Okay, so we have a 2-year budget already in place and can count on this massive supply of debt to hit the markets week after week. We have a set schedule from the treasury that just works like clockwork. And so predicting that the Fed's balance sheet will increase is not too difficult while yields are this low. So the big thing I'm really focusing on now is watching these auctions, and as the yields rise, to see if more and more of this debt is picked up by foreign investors rather than primary dealers. Primary dealers by law have to buy this debt, and that's your JP Morgan, who, don't forget, just put out the most profitable quarter of any bank in history, period. So you think they might be having some trouble with this forced purchase of assets, but oh no, they get to flip it to the Fed for big profits at no risk. Okay, so these are the biggest points we're focusing on. I'd like to jump back to our trade alert to look at our positioning. Okay, so open positions, as you know, I've been bearish on the TLT. Thursday, we had a loss. The previous Thursday, we had a win. Today, we're up big, 77 cents a share, or a profit of $2,926 from a trade alert just issued yesterday. And this is what we call the inverted option caller. That's a nickname that we did coin here, so I don't think you'll go find that in a typical option course. It's a simple strategy. It allows us to take advantage of owning 100 shares of the TLT, sell an in-the-money covered call, and then buy an in-the-money put option. And so the net result of that is you'll lose if the TLT travels higher, and you'll win if the TLT travels lower. So we're just near the beginning of the profit zone on this, and our profit gets cut off. And you can just remember this in our strategy, your profit will always get cut off when you reach the call option we've sold. And if it's a downward bet, then that'll be maximum profit is achieved after TLT goes below 136. And typically our maximum loss is cut off after going to the price tag of our put option. And in this case, on the TLT, that's 139. So we can still pick up another $1.60 approximate profit on this trade. And this is a position I do believe we can play for the next several months, at least through April. There's an interesting trend that has not failed in history, and that is if the Fed is cutting rates, TLT goes up, and it's almost exclusively done after stocks have gone down. Okay, so that's number one. Number two, if the Fed is not doing rate cuts, but rather they are purchasing assets, which are always US government debt, we have the exact opposite. Stocks go up and the yields on bonds rise, so the prices of bonds go down. And so our call on the TLT is for it to crash to 120, which is where I believe we will see ample support for foreign investment to pick up this debt. And we may see the first freak out in the stock market around then. If you did listen to Fed Kaplan's speech this week, the Dallas Fed, great speech for boot campers. It's their first video to watch tomorrow. They're really committed to expanding the balance sheet through April. At that point, they intend to try to really slow it down. And so for this all to work out, they really need yields to rise to a point where the stress is not put on the US banking system, but rather is able to put the burden into foreign investors who want to get some yield as their government bonds yield next to nothing. And so that's the big trend that we see developing in 2020. Emerging markets were playing a little different than the SPY. The SPY were selling call options to finance a put. Keep in mind, SPY's at all-time highs. It's extremely leveraged, and it's fueled by the Fed's balance sheet. So we've really gotten ahead of ourselves in terms of earnings, and the market's counting that we do see some good growth in earnings. Now, with the debt this high, the U.S. government, it's almost surefire that we should see earnings grow because that money flows right into the U.S. economy. So I think from that standpoint, that's not a huge risk. Emerging markets is not trading at all-time highs, nowhere near it. So it's a value play at this point. So we're simply buying a weekly put option and then allowing this asset to rise. My expectation is for this to blow past its 2018 high of 52. Now, we did get some good data out of China overnight that perhaps their growth slowdown is bottoming out. Now, they really control the GDP numbers they print simply by issuing new currency. And it's a very controlled economy. So they could really print just about whatever numbers they feel like. But the good news for China is if they really do agree to this US-China trade deal, which so far it looks like they will, a big part of the bargain is that the US banks are coming in to help finance China and its big projects, which will require trillions of dollars and keep their labor force active. So I think there's some very big moves ahead for emerging markets. And if there's not, this ETF, which represents 10% of our portfolio, will be a great warning sign that trouble's ahead. So if we don't see emerging market pushing up in the next several months, that would signal that the China slowdown is worse than expected and will probably start to wreak havoc in emerging markets. And our best look at how to deal with that would go back to looking at 2019. Now, of course, the Fed policy in 2019 was far different than current. So we'll deal with that if that's the case. But really, some key things we're watching is a weakening dollar, a strong emerging markets, and a rising yields on the long end of the treasury curve. So if those three things aren't happening in tandem, our entire strategy for 2020 must be reevaluated. So far, everything's happening exactly to that. GDX is our gold miners. If the spot price of gold is expensive, which it is, this is a rare time where the gold mining industry can actually turn a profit. So we prefer to own the gold miners versus spot gold. And so my anticipation is a good return in 2020, but a great return in 2021, as I expect that we do get a stock crash somewhere towards Q3 or Q4 as yields crack the stock market, just as we saw at the end of 2019 when the 10-year treasury hit 3.2. And so the basic idea is that if yields get too attractive in the bond market, that will cause a lot of money to flow out of stocks and stop this momentous rise. It'll also stop the Fed from needing to grow its balance sheet. So you get the double whammy. So I do expect that we can hit 360 on the SPY by May, and then start to get concerned about the growth of the balance sheet slowing down as foreign investors pick up US debt as the yields get too attractive. And so if we do get a stock crash going into Q3, Q4, most likely the Fed will save the day as they did this year by cutting interest rates and then going into real QE in 2021. So I think that's what we have headed our way. And that's when I really expect the big fireworks in gold. Now, if I'm wrong about China and we get a slowdown faster than expected, we don't see this growth pickup, PMIs continue to lag, then we might be seeing that schedule work its way a little sooner than expected. So I like to be long GDX, but short term, I don't see that happening. So we are buying a February 28th put that's in the money, which simply means we're locking in the maximum loss on this position the second you enter it. And that loss is around 2% if you were to enter it today. When I put the position on, 2.5%. And the bottom line is I need the GDX ETF to appreciate by more than the cost of my put option to start earning a profit. So until we get just above about 29.60 or so, that's when I'll start realizing a profit in my GDX position. But if gold sells off because everybody's euphoric and chasing stocks, which could very well happen, I lose very little. GDX represents just under 10% of my total portfolio. So 25 basis points or 0.25, a quarter of 1% is the maximum loss I can incur with this play between now and February 28th. So that is our trade on gold currently. My expectation is that we could see potentially mid 30s in 2020 on GDX, and then going into 2021, 22, if my timing's right on the rate cuts to zero and the real QE, where they're not buying the front end of the treasury short-term debt, but they start buying long-term debt, which really distorts markets, that we could blow past the recent high of 2012, which was in the 60 range. So I think this could go dramatically higher than 60 in the next several years. But timing is a little tricky because we do need to keep an eye on emerging markets. If we start to see emerging markets fail to break past its recent high, I would be more inclined to expect a quicker rise in gold. TLT, the good news for us overnight was the introduction of the 20-year treasury. They've been joking about a 50-year and a 100-year bond. Currently, there's only a 30-year. They discontinued the 20-year in 1980 and are reintroducing it. So that means the TLT, which only carries the 20-year and 30-year treasuries, is going to have a huge, quite likely a doubling in terms of the amount of debt with outstanding at all times in the long end of the treasury curve. So that did apply a lot of pressure on the TLT and gave us that quick profit overnight. But the big picture is, without failure, as long as the Fed is doing quantitative easing, this has an effect of pushing capital into stocks and creating a drag on bonds. And so we want to be bearish the TLT so long as the Fed is increasing its balance sheet. Okay, let's see if we have any questions, and I'll jump into some news. Go ahead and unmute everyone. Oscar, Murray, Gary, MH, Ash, welcome. Ron, Mike, Mark,
Jason, how
Karen,
are you?
doing good. How are you doing?
All right, man. Interesting
Finally,
day.
finally seeing our TLT payoff here, huh?
Yeah, didn't expect it with the SPY going crazy.
Scotty made it in. Hey, Scott, how's it going?
Doing great, Jason. Thank you. Hey, I had a question, but I think it's a little more, just a little bit more involved. I may try to give you and Dean a call after, if you don't mind.
Sure. Yeah, absolutely.
Okay, good. Thanks.
Murray, what's going on in Cali? You got your mic on today? Donald, how's it going?
Great, Jason. How are you this morning?
Doing good. We got a little snow overnight, so kids had a 2-hour school delay.
Well, you can keep it if you would. We got rain in Arkansas. So.
Oh, nice. Karen, we always count on you for a comment each day. There she is.
Actually, I had a fast question. You might have said it, and I might have just missed it because I had an interruption. That Spot Gamma website that you were looking at. Those open interest, is that some type of collective over what period of time, or
right? So that I was trying to find something to do this for quite some time. because I used to just have to go through each chart and kind of eyeball it.
Right.
So that's all the dates combined. All
Wow.
open interest at that strike, no matter the expiration.
Interesting. Okay.
So
Thanks.
it gives you a pretty good idea where there's resistance.
Right.
Now there's not a whole lot of, let's see what's going on in the put. I like to design the put to be more relative to what our potential profit is. So I'm more interested in where we have resistance than where we have downside protection. Right now, the market's just completely discounting the risk of a sell-off altogether. You can see there's, so the market's really set up for some volatility here. If we get some big hedge funds trying to shake the apple tree a little bit.
Hey dear, how are you?
Yeah, it's crazy. There's my comment for the day.
Yeah, it's absolutely nonsense. I've got a good video coming out for boot camp. This guy goes through, it does a good job looking at how we measure GDP against inflation, how they measure inflation. And it does provide a really good argument that we've actually been in a recession since 2015. Once you really look at growth minus the debt, the government spending, and then you also look at the real inflation numbers. And then you can start to understand, why does the government have to create so much debt to operate? And why does our Fed have to pick up that debt? And why are yields low all around the world? So it's a really good piece that does help explain why we have this maniac central bank taking over monetary policy worldwide right now.
I was going to say low or negative.
Yeah.
Yeah,
exactly.
right. Yeah.
And Jason, real quick, Perry typed in, how do you get your upside projections?
Okay, so the 360. Yeah, I've had a pretty good knack at predicting price targets relative to key catalysts on the SPY recently. That's just a 10% rise based on a 10% drop in the TLT. And so those two are quite correlated. I'll be more, as far as predicting the top in the SPY, I think it's going to be more related to when that 10-year yield breaches 2.8 and then hits 3. The second we see the 10-year yield go from, it's probably just over 1.8 right now. As soon as that gets to 2.8, that is trouble ahead for stocks. So that's really when I'll start to extremely tighten our option collars. We have very little to lose on the SPY, and reverse our trade on the TLT, expecting that there will be a stock crash and that the Fed will save the day by going into rate cuts, which is what they always do. So, and they still have a little ammunition. They're starting to talk about, well, they're trying to create this feeling that they can use forward guidance, negative rates, never-ending repo to not have this situation where they quote unquote run out of ammunition. That's been what a lot of the legendary hedge fund managers like to say, is that the central bank is just about out of ammunition, because the last few recessions, they had to drop interest rates 5.5% to get it out of a recession. But they're saying that forward guidance can act as a few percentage points. And perhaps the closer you get to zero, there might be more of an exponential effect on lowering interest rates. So perhaps dropping the interest rate from 6 to 5 is nowhere near the effect of dropping it from 1.75, where we're at now, to, towards 0. Okay, so we have, what inverse S&P equivalent ETF would you use if stop trading SPY? I'm not going to stop trading the SPY, Don. I'm not going to, you guys, just because this is so easy for us to follow. It covers the core markets, so it really puts our attention in the right place. I'm not going to change these ETFs, period, for the remainder of the that we serve this program. So there's really no need. We're not going to see China go away from the second most powerful country in my lifetime. So we got to focus on China. The US debt's going to be the biggest debt holder for my entire lifetime. So we don't need to change our debt product. And most likely the S&P 500 will remain the biggest stock market for my lifetime. So the whole thing here is that we want to focus our attention on the biggest markets. The biggest problem I've seen with a lot of investors is they get into some sort of niche strategy and they laser focus in on that. And they might make a lot of money, but then some bigger macro force comes over and it wipes out their strategy and they didn't see it coming from a mile away. So if I think there's an opportunity for us to make some extra money with a low risk, that'll be delivered in our Friday boot camp bonus trade alerts. So yeah, we won't be changing anything because we can change the option to predict a down or up or flat move. So really, we're in the business of predicting the big picture and then designing safe trades so that if we're wrong, we barely get a scratch. And if we're right, we collect nice, easy profits. Okay, here's some funny, any other questions? I am planning to do a very detailed video after this webinar, which will go out Sunday, reviewing our track record, going over the US-China trade deal, looking at the impeachment, and then also looking forward into the future, into the election, which probably be some key headline risks going into 2020 beyond China recovering its economy.
Hey, Jason, question.
Sure.
You're not going to do any kind of a presentation on Monday since the markets are closed, right?
Correct. So no Q&A webinar this Monday. We have module 4 part 2 Tuesday, where I'm just going to demo how to do the trades from the Thinkorswim phone app. Tuesday we'll roll over our emerging market put and remain long. Wednesday we will be back to the SPY. So because of the length of time that we're going to be out of the trade, I did decide, and plus not seeing that gamma move up, I did do a little bit tighter option collar. So if there's any volatility, again, we'll barely get a scratch. And if there is another big up move, which probably the most likely outcome, will still benefit all the way up to 333. So
Thank you.
yes, sir.
Very nice. And so just real quick, guys, does everyone understand how and why we look at the financial system and why that's kind of our key indicator that we look at as much as we possibly can and learn about as much as we possibly can? That's it seems to be a very foreign concept for most people when I first speak with them. And the more I talk with them, they definitely get it. But so any additional questions on that, guys? Guys and gals, I should say. All right. So very good. Let's see. Okay, I'll let you keep going there, Jason.
Okay, cool. Well, again, I will be putting out a more detailed video Sunday, which I'm going to record today, where I'll cover all the top news. I'm going to go over a track record in detail. In fact, let's just pull that up real quick so we can go over the track record. Okay, so what I've been doing lately is I'm including the trade results of the specific asset we're trading each day, plus the total return when you do overlap all the strategies. And so if you do look at the SPY track record, you can see we had a very healthy 17% return in 2019 with only 2 losing months. And during those months, we only lost 1.2 and 1.1%. So if you do compare it to the S&P 500 in its entirety, you had 17% drawdown in December, and you had 7.5% drawdown in May, and another 7.5% drawdown in August. So we've produced a better return relative to risk. And so if you're buy and hold investor, you know, you got lucky a couple times just holding in onto these losses and the market recovered for you. But will that last forever? And how much volatility do you really want to have to watch in your portfolio? So with our strategy, we eliminate that entirely for you because we always have put options below our assets. And now, if you do look at the overlapped return, the total return is less, but the volatility is even less. In fact, we've only had one losing month, which was last July, and I was positioning us for the potential for a trade war escalation, which I still think is coming in 2021, right after the election's over. Assuming Trump wins, I would presume that we really get into phase 2 of the trade deal, which is much more complex than a simple purchase agreement. But with that said, if the Chinese really do this massive $100 billion a year increase in asset purchases, and in fact, it's 200 billion as they grow it in the next 2 years, we'll see just how rough Trump wants to get with them, because of the risk of losing all this new purchases we're picking up from the Chinese. So our goal again is to create profits with low volatility. And really what you should measure your results on is not just your total return, but what was the risk you had to put your portfolio through to realize those profits. And so if you're risking 5, 10% to make 15%, that's not really a great return. In our portfolio, you can see we've risked no more than 1% of our total assets in any given start to end of a month and have generated 17.5% return. And this has been a very difficult period of time to trade a highly uncorrelated portfolio. So we didn't pull this off just being long stocks and getting lucky. We had stocks, bonds, emerging markets, and precious metals, as well as put options at all times, which create another drag on the return. So again, to make this work, we have to predict the markets accurately and then safely grow the wealth. Okay, guys, any questions out there? I'll probably save most of the news for our big piece coming out Sunday, Dean.
Sounds good. And Oscar said, got to run, but I'll listen to this weekend. Best wishes and thank you, Jason and Mean Dean.
Oh, too funny. Okay, great. Well, do you want me to put it back on your screen to wrap up, Dean?
Yeah, and just any questions out there, folks, at all? Scotty, you want to just maybe bring up what you've been thinking about? Be happy to work through that now. I have kind of back-to-back calls set up for the rest of the day.
I could give you a call. Scott has told me he wanted a call last week. I think I caught him while I was traveling.
Okay, got it.
Thanks for that offer, Dean. Thank you, Jason.
Yes,
Sure.
sir.
Yeah.
Appreciate it. Okay, any questions, guys? Let's
Hey,
see.
Jason.
Let's see. E. Roger. I know you guys are all new here. Perry, I know you're fairly new. I see your microphone's unmuted. Any other questions?
Donald had one. How's it going, Don?
Fine. I just wanted to verify, you did say you were going to have the second part of boot camp 4 on Tuesday.
Yes, sir.
Okay. What time is that?
2 Eastern.
2 Eastern? Okay. Thank you. Have a great weekend.
Oh, thank you, Don. And I know you're looking forward to getting that phone app working for you. So
I'm trying to, yeah.
yeah, if you want to, you could download the Thinkorswim phone app. It'd be the only thing you could do. I mean, that'll take you a minute. So
Yeah, I've got it downloaded. I've been working on that regular Thinkorswim program.
it's too much. Yeah, it's just too much.
Got way too much stuff for what I do anyway.
Yeah, we're not trying to. There's just no reason to make trading complex. So
Yeah, that's something Wall Street engineers to confuse people. Yeah.
Well, it puts the advantage to their side, I think.
Yep. Yep, exactly. And it's funny, no one out there teaches you how the central banks manipulate, control, and drive price action in the markets, right?
That's true.
I
That's
think
very true.
humans stopped outthinking computer. When was that? The Microsoft's Big Blue or something like that started beating the chess champ.
Oh, it was IBM. Yeah, IBM's
Oh yeah,
Watson.
IBM. There you go. So that was a couple decades ago. So we don't have any way to outperform the computer at its own strength.
Well, you guys, because I'm new at this, but I'm finally beginning to get my head around what we're doing here. I mean, this is so little risk. It's just unbelievable. And if we can make the 1%, or in your case, you've been actually beating that a little bit. That's pretty darn good money.
Yeah, it's not bad. And, the catch is we have to be pretty accurate. Otherwise, one position can drag on the others. But you're right. The good news is the trades are constantly designed so we can never lose more than 1%. Sometimes if I'm really feeling it, our biggest risk might be 2% in a position. But in general, I design it so the most we can lose if we're wrong is about 1% on the position. So, and then you figure that, each position's no more than 40% of our total portfolio.
Yeah.
So we're usually no more risk than 0.4. And luckily right now we have a period of time where the Fed is actively distorting markets. And so those periods are a lot easier to predict than when they're not, because now we got to worry about real economics and real business data instead of kind of this whole distorted world that we're currently navigating.
Well, I tell you, I think every one of us needs to take our hat off to you guys because of the research that you're doing. I don't think any of us, I know I certainly could not even come close to getting the amount of information on a daily basis that you guys do. I don't know how you do it, but
How much did Dean pay you to say that, Don? Come on.
No, I'm very sincere. I'm very, very sincere.
Appreciate the
real
compliments.
asset.
It's a lot of fun. I really enjoy doing this. So I'm glad you're having a good time.
Well, if you can have a good time and make money at it too, that's the main thing.
Yeah. Well, when we first met, Don, what were you doing? You're doing the dividend strategy, right? With some loser companies.
Getting my butt kicked is what I was doing. Yeah, it's certainly turning around for me. I will say that.
Oh, that's great to hear.
Very nice, Donald. Are you currently over $500,000 behind this now?
Just a little under right now.
Okay, good.
Yeah, I'm slowly putting more and more into this program. I did some year-end tax selling on the dividend program, so it freed up some cash for me, and I'm like I say, slowly working my way into this program. And I don't know where I'm going to end up with it. I'm still doing some on another concept that I'm doing where I sell some cash secured puts. And what I'm doing is I'm probably going to have 50-50 and kind of see where we end up at the end of this year, and then slowly start putting my money on.
Careful selling puts after April 2020. I'll tell you that.
What was that?
I'd be careful selling put options after April of 2020 because that's when the Fed's.
Well, I'm skeptical of it now, even to tell you the truth.
Yeah, they call that the anthill strategy. So you walk up the anthill, nice and fine, and then you fall to the bottom of the pit.
Right.
Yeah.
It can happen.
Yeah. There's a lot of famous investors who've gone completely bankrupt with that strategy. But they get greedy. They start off. It's all about how you play. You can play that strategy. And I had a guy who was trying to make like 5% a year, who hadn't lost for decades, selling super out of the money puts. but he had some periods of time where he did hold some 20-30% drawdowns. I think he was trading like 10 million bucks.
Holy smokes.
But you know, just recently there's a guy doing this in commodities. He lost, it was all over the news. I think he lost $150 million, one big crash in commodity prices.
Well, I can.
Or
see
yeah,
where-
natural gas. That's what he was trading.
Natural gas, yeah. I can see where a guy can get overconfident in what he thinks he's doing and what he thinks he understands and get his
Well,
legs
here's
cut
the
off.
fallacy in that strategy. They figure if I go far out enough on the puts, well, I'm not going to make much, but there's no risk. So then they go leverage into that 100 times.
Yeah.
And then that bizarre, crazy piece of news hits, and you get wiped out. So
Yeah.
No, you're going to see. My previous job was managing everybody under the sun. So I've seen just about every trading idea you could come up with. And first of all, nobody had anything like this.
No.
I've never seen anything even close to this. But yeah, the other thing I found was that most people who are buying these programs, they don't realize that they don't have new source of income, so they can't afford to take big risks, because if they're wrong, they're not going to be able to replace that cash. And the second you take a big loss, you get in this mentality that you got to make it back. So now you're doubling down. You're holding on to the loss. You got this. I'm not going to sell it. It'll go back up, and the losses grow. The pain grows. You continue to make a bad decision after a bad decision, and all of a sudden you lost $500,000, and it was just completely unnecessary.
Well, and it is. Of course, a lot of it depends on, like what Dean was saying. He took a pretty good hit, but he's young enough to recoup. You take somebody like myself, you take a hit like that, and boy, you don't have the time to make it back out.
Yeah, exactly. We were talking to a fellow who picked up a 6.5% total portfolio loss on Tesla in a single day just this week.
Oh, smokes.
There's no need to be trading like that.
No. Well,
it's not competing with anybody, except himself. So it's just completely.
Well, that's just shooting traps. Is what it is.
Yeah, and Donna, honestly, I think losing that $250,000 in a week, I think really it was honestly the best lesson I ever had, because it really taught me to be defensive with my investments. And
I would hope it did.
Yeah, it was expensive, but man, that's what shifted my mindset and my methodology to be defensive. And man, life has just been so much less stressful and more consistent since then. So.
Yeah. Well, that's good. That's good. Well, you guys have a good weekend, and we'll talk to you on Tuesday.
Okay, sounds good. Can't wait. Thank you so much.
Thank you so much, Donald. Appreciate your comments there, bud. We enjoy working our butts off for you guys.
Sure. Appreciate your help too. Thanks so much. Bye-bye.
All right. See you later, Donald. All right. So E. Roger, I saw you typed in, that's me. What was that in regards to specifically? I wasn't sure. I didn't see when the comment came in. So
I think they're talking about you take a little loss and you hold on to it, and then it turns into a bigger loss, and then all of a sudden you're doubling down. Is that what you're responding to? Oh, he's got his. Go ahead.
Yeah, that's exactly it.
Yeah. Hey, it happens to probably just about everybody. So do you have a specific story you'd like to share?
Well, I had, Cliff Natural Resources. I bought the stock, and I thought it was a good stock, and it would go back. And within a day, it dropped. I think maybe $20. I was working because I bought it at $90 something a share, and then I decided to average down. And it just kept dropping. And of course, I didn't know much about trading then. And I thought, oh, well, it will come back because it's a good stock. Well, since 2008, it hasn't come back. Well, it dropped to $2, but now it's up to,
Oh,
yeah.
so when did you get out altogether?
I didn't.
Oh, shit. Well, I'm sorry to hear that.
Well, I keep thinking it's gonna go up because like to lose like, what, $60,000, it's like a lot of money.
Yeah.
So I'm still there, thinking, well, my average is like $55 or $50.
Well, the bad news for that stock, all the money is going straight to the top right now. So it's all going to Microsoft, Apple,
Yeah, I know.
and that trend probably will not change anytime soon,
No.
unfortunately.
Well,
Yeah, and you let that's just and that's why I love the strategies so much. You're never gonna lose more than 1%. I mean, it's not physically possible with the way we engineer everything. So yeah, we'd love to show you how to put yourself in that scenario, and you can absolutely follow the trade alert we put out on the SPY, and see how that feels from today until Wednesday, and see if we're profitable or unprofitable at that time. And like I said last time we spoke, if you don't want to do it with real capital to start, I completely understand. Put the trade on a paper trade, and maybe replace it with the maybe $50,000 worth of the cliffs that you have now. Put that in a paper trading account, see what it does see what the having 1% risk or 0.4% risk really on that position feels like from today until Wednesday. And there's just you don't really worry about it when you engineer that intelligently and that defensively.
Yeah, so here's what a lot of people do when they have a loss is they get this mentality that they got to make it back quick. So they're looking for that hit that's going to get them back in the game.
well,
And that's usually what lends to another bad decision, unfortunately.
yeah, I tried to make it back, but I just kept losing. So I'm scared of options.
With our program, you're scared of options, or just trying to
Well,
get rich with options? So you got to realize we're in the business of using options the opposite of most people. We use options to protect the portfolio and not to make money. Very, very rarely do we use options. So the saying is the smart money sells options and buys puts, and the dumb money buys call options. And that's just really here's kind of the here's who we have in the option space. We have huge banks that like to write put options.
Yes.
So that's a big business, and they can afford to do it. Okay, that's one. Two, we have kind of like your gambler type who likes to follow earnings, chase hot companies, play momentum. They like to buy call options.
Yeah.
And then you have big equity holders who realize there's free money, which they can use most usually to just finance downside protection to sell call options. So that's what we do. We're in the, we'd like to own the asset, take advantage of owning that by selling call options to speculators, and then take advantage of the big banks who are happy to sell put options. So it's kind of like we're buying insurance for our portfolio constantly, but we're letting somebody speculate who wants to get super rich really quick. We're letting them pay for our insurance plan. We get to benefit from the assets appreciating. And then we get to allow the gamblers to pay for our downside protection. So it's a good setup. But you shouldn't feel like what we're doing is risky. Because again, as you could see just from the comments, it's the opposite of risky what we do. Now, where do we have a hard time selling this program to potential clients? Okay, it's not because we're on the risky side. Sometimes it's because we're not risky enough. People have this greed mentality where, I don't want to make 1% a month. I want to make 5% a month. So that's the kind of person we have a hard time bringing into our program because they're trying to make up lost ground. And until that person is ready to realize it's just not going to work, that they're better off being the turtle instead of the rabbit.
Uh-huh.
You know, until you get that through your head, you're not going to enjoy this product or want to join it. But the second you do, now I was speaking to a guy who, you know, he's a millionaire. He's the guy in that Tesla position. I said, look, you're better off putting your money behind our strategy, making your safe 1% a month. And then I can tell you, you have this risk appetite that is not going to be quenched with our super safe program. But the good news is I am giving you very accurate macro predictions. So if you have a hot stock, well, wait till I give you, hey, this is a very bullish environment. Take some of your profit and then go buy that super risky call option. And that way you can have that risk, that excitement you're looking for, but you're going to risk a couple $100 instead of, you know, the fellow we're talking to had lost $65,000 in a day,
Oh, boy.
which was 6.5% of his portfolio. There's no need. There's just no need to do that. Make 1% a month safely. And then if you want to speculate, take a little bit of the profit we're generating and go take on that risky call option on a stock you've researched, if you really want to do that.
Okay. Oh,
Scott says he follows that advice with the 401. Yeah, so certainly, I mean, if I had removed all the option trades on our strategy, we'd be up a lot more than we are now. So this is a super defensive strategy where the options are a drag on our return.
mhm.
But that's where the clientele are that we need to serve. They need to protect capital as the number one goal and generate return as the number two goal, and not the other way around. And that's simply because most of our clients don't have a new source of income. You can't count on the profits of your portfolio as your income to replace loss. It's not a smart strategy, because then you take a big loss, you're going to take on even more risk to replace the money you lost.
Right.
So unless you have a huge salary to replace losses, you have no business taking on big risk in your portfolio. So if you're making, you know, a huge income from your job, you could afford to take more risk because you can replace your losses when you're wrong. But if you're retired, you have no income. So you have to play it absolutely safe and just, you know, deal with the facts. You know, this is the right way to go into retirement and play your portfolio.
Right. Okay, well, I will try to do it at, I'll try to paper trade it.
Yeah, if you download the Thinkorswim phone app, they'll start you with two accounts that are paper trade.
Mhm.
Just flip it over to the paper trade, and you can put. It'll give you a cash account of 200K, and it'll give you an IRA of 100. And
Okay.
so you could paper trade. You know, it's real life quotes. It's exactly like trading in the real world,
Mhm.
and probably the best way to paper trade.
Okay.
So yeah, once again, that's the Thinkorswim phone app.
Okay. I'll do that.
And Tuesday, we're actually going to do a whole module for our boot camp clients that will show you how to use that specific app. It's really nice for following our program.
Where are you going to give the, when are you going to give this workshop?
It's our boot camp is every other Tuesday,
Oh,
and it's about 18 different modules, and it repeats every about 2 quarters over and over again. So we do give a 30-day bonus into the boot camp right now when you join the advisory. So those are 2 different products. And quite a few people in here actually do have the boot camp. So Donald's in that camp, Scott's in that camp. I think I'd have to go through it. So Dean's been growing our following pretty rapidly. So I do need to spend some time and go through all our clients so I can make sure I give shout outs to everybody supporting us.
Yeah, and I know you're up in Canada with a couple different brokers, but any of the brokers you're using currently now will have paper trading, technology built into them.
Oh yeah, so this is the broker I found for Canadians that seems to do everything we need. I did talk to them. They definitely have all for ETFs and options. Quest Trade for Canadians.
Very nice. Very nice. All right, guys. Scotty, are you sure you don't want to bring up any questions? I know Karen said tell Scotty it might be something we could all learn from you. So definitely happy to do it. Have Jason call you too. But yeah, if you want to bring anything up, Scotty, definitely might help the group. Learn from your questions or your comments.
I think he's just interested in transitioning from the boot camp into the advisory. I'm guessing so.
Oh, okay.
And then
Yeah.
catching up. He missed out on a few modules to catch up on too.
Yeah, that's it. Exactly, Jason. Thank you.
Mind reader right here.
Nice. Very nice. All right. Any other questions here, guys? See, I think everyone's microphone is unmuted at this point. Did everyone enjoy looking into the Fed balance sheet and seeing that expansion? That's can't tell you how incredibly valuable that is, and just how key it is to know what's going to go on for the next week in the market.
Yeah, it'll be really interesting when we see them stop selling the notes and the bonds and start buying them. That's going to be a big change in their policy.
Right.
All right. Well, I think I'm going to get to work on the weekend update. So in the weekend update, we'll review the track record, market predictions, go through a ton of charts, and also look at the news, the trade deal. I heard somebody's voice. Go ahead.
Yeah, excuse me. This is Ed. Can you go over, where you have the highlight on what your expectation about when they switch to nodes?
Okay. Good question. Yeah. So that's what they will call real QE. So if you hear the Fed continue to say it's not QE, their reasoning is because the T-bills all expire in less than a year. So they're assuming that, hey, this is a short-term support to the economy and not a long-term distortion, because all these debts will roll off their balance sheet. Whereas if they're buying the notes and the bonds, this would distort markets for years to come. And so that's what they call real QE. So we're going to need a real crisis for them to be able to pitch this to the world. So my expectation is that we will see a stock market crash at some point in 2020 that is short-lived because the Fed cuts rates to zero and then rolls into real QE. So I'd expect this to happen in 2021 and for the rate cuts to happen at the end of 2020. And that's when I really think gold will take off, more so than it is currently. But, I'm open to being wrong and keeping a close eye on it. But it's just hard to imagine that they would do anything aggressive with stock market at all-time highs, employment at very low rates, and there's no major fear of a trade war right now. So yeah, I don't think that's coming till we have a crisis.
Okay, thank you.
Yes, sir. And Ed's in our boot camp. Thanks for joining the boot camp, Ed.
Sure, thanks.
Yep, Ed is our newest member here. So joined the program earlier this week. And Ed, are you having fun, making a little money so far?
Yeah, I should have done something yesterday that I, let my work get in the way. So, but I see the direction is right, so I'm happy about it. I just picked up the SPY trade today.
Okay, excellent. Very nice. How many shares did you pick up, Ed?
I started with 100. I'm doing the 75,000.
Sure. Okay. Awesome. Yeah, and you'll probably be like Donald here and scale up slowly, and then
I hope so.
yeah, it's fun. It's always fun to learn kind of where people start and where they end up. And I would say probably 90% of our customers that have been with us for a year have scaled up to their liquidity limits.
See, Murray, you out there still? I always like to hear from Murray. He probably spent the most time out of any member with Murray one-on-one.
Yeah, it looks like he's on. Let's see
Murray,
here.
your microphone's muted.
Hello.
There he is.
Yes. I just sent you a text, but the question I have, I don't know if many people would be interested. That is, I have multiple accounts in the market and come around to appreciate your system and would like to trade, 2 are IRAs and 2 are regular. And I'd sort of like you to use your system on all of them, but I see it as being.
I would use one ETF per account so that you don't have to log into so many accounts.
I don't quite get that. One ETF per.
So, okay. So instead of having like the whole strategy in each account, you might use the TLT for one IRA, use a SPY for another equivalent IRA.
Okay, I see.
So you're only having to log into one account per day. And so if you had 3 accounts, let's just say you had 400,000 in one, use that for the SPY. If you had 400,000 in a second, use that for the TLT, and then have 200 in the other for your gold, emerging markets, and your bonus trades. And that way you're not having complete chaos trying to overlap.
Yeah, that's
you'd be logging into 3 accounts every day.
Yeah, it would be 4, and that's too much.
Yeah, that'd be too much.
And one thing I've done actually last year, Murray, is I actually merged two separated IRAs. I just merged it all into one with TD, and that was nice for me.
You could do that? Is that a legal question, or is that just a physical thing for the brokerage?
Call up the brokerage, Murray. They'll definitely let you know if you can do it or not. And it's probably going to need to be a similar IRA setup, but yeah, they'll definitely do everything they can to get it done for you.
Okay, good ideas.
Yeah, if they're the same type of IRA, you can just do brokerage to brokerage transfer, account to account, and you won't have any issue with that. But you have to do it very specifically and let them do it. Do not take delivery of that yourself.
No, but if it's for 2, it's for my wife has one and I have the other. Can you still merge?
Different. No, you can't. You're 2 different people.
Okay.
Yeah.
Okay.
Call them, Murray, and just see what's available to you.
Right. Okay. Thank you much.
Absolutely.
My pleasure. For boot campers, no new trade today. I was tempted to get a really out of the money put on TLT, but we just had such a big drop on the TLT. I'd like to do it after a little bit of a bid. So maybe next Friday, we might look at that one. Not ready to buy any VIX call options yet. So that's also on the radar. Those are really my 2 most interesting trades. As far as the update, we do have an update. UK had to cut rates, which is surprising. I believe that'll be their last rate cut. So that's why we have a little bit of a pullback on our English banks, but we remain long that. That update will go out shortly. Tomorrow I have, I believe, 5 good videos for boot campers, one of which is a great speech by the Dallas Fed, really lays out a lot of really good information. And then some more, I guess you call it conspiracies about the central banks and how the government manipulates inflation that are very interesting as well. Some information, I got Kyle Bass and Steve Bannon's take on the trade deal, as well as Chuck Schumer's take on the trade deal. So
oh boy.
Oh yeah. and yeah. All right, guys. Well, I think that was a great webinar. I want to thank everyone for joining us. Any last questions or comments before we wrap it up? Oh, boot camp update is out, Ryan says. Okay, good.
Thank you, guys.
Okay, pleasure. Thanks, Don. I really appreciate all your kind words.
Sure.
All right, until Tuesday. Thanks, Karen.
Thank you all for coming out and putting your capital behind us, guys. We truly appreciate the business and absolutely love to help you grow your capital in the safest manner possible.
Thank you so much.
All right, you too, Perry. Have a great weekend.
See you guys Tuesday. Bye.
All righty. Thanks, Jason. Great presentation, bud.
Thank you, Dean. Great job. Let's see, I might have to reclaim the host.